Hello, and welcome to another episode of our VIP series. My name is Rufas Kamau. I'm a markets analyst at FX Pesa. So we'll be looking to understand the key technical price action patterns that tend to dominate the gold prices, as well as oil prices. We'll also be looking at a couple of indices, as well as the major currency pairs. So thank you, Tashi, for starting the session and also planning it all the way. And also, I would like to welcome everyone to the session. Thank you for taking your time to join in. So now that I've mentioned that we'll be looking at technical trading patterns, it's very important that I start from the very basics. So one thing I'd like to begin with is that for the basics of trading, I have already done a very important course. The course is available on YouTube, that is the on FX Pesa channel. From there, you will find the Novice to Pro series that basically takes you through all the beginner content, right from how price is formed, understanding candlesticks, different candlestick patterns, risk management, and all that. So today, I am expecting an audience that has already gone through the same. So an audience that at least understands candlesticks, price patterns. So from there, we develop a focused presentation where at the end of the day, you will be able to understand the key price patterns that are very common in these assets, and you'll be able to use those opportunities to your advantage and hopefully get to make money out of that. So for instance, we already have one chart that I've already shared here. The chart that is on your screen right now is the chart of the US dollar trading against the Canadian dollar. And the price pattern we are focusing on is called a symmetrical triangle. So it's a book pattern where the market tends to lose volatility over time. And also the trend seems to be sideways, not in a range, but in this case, in a pattern that looks like a triangle. So the way to identify these is simply by plotting your trend lines and seeing the market giving you information such as follows. So the first things first, the USD card pair swings from this high here and then drops all the way down to this support here, goes up and then forms another support level here before rising all the way up to this point. So the first things you'll notice is that on this kind of movement, the first move will most often be bigger than the second move. So the second move is a little bit smaller than the first move. And then on the third move, it even gets smaller. And every proceeding moves keeps getting smaller and smaller. And this basically forms the basis of your pattern. So in this case, what we are looking at is a market where the swings are getting smaller and smaller. And if you compare the swing high and the swing low points, so the swing high point in this case would be the market going up, finding resistance and going back down, basically creating a swing high point here. So in technical analysis, the word swing has really died over the times. So people just use the highs. So market goes down and then swings upwards, and now we have a low. We have an intermittent low here. So the second low is higher than the previous low, but the second high is also lower than the previous high. So the highs keep getting lower and lower, and also the lows keep getting higher and higher up until the two trend lines approach each other. They don't always meet, but whenever they do, the opportunity can be really awesome for you as a trader. So let me clear this. So as I was trading this one, it was pretty easy to identify and look for trading opportunities. So notice how the sizes of the candlesticks are relatively big. Here they are small, but on the movements, the big moves or the impulse movements, we notice that price patterns are much bigger. And then as we approach the junction between the two trend lines, the candlesticks really get small. And if you focus on this area here, you'll notice the indecision in the market where we don't yet seem to see or identify a big momentum movement up until we got to this area where you see the area highlighted in yellow. So this was the first time in quite a period of time, or in quite a number of days. Remember, this is a 1 hour chart, that we have a strong directional movement of the trend lines. So in this case, it's a clean break towards the upper side, indicating that the market has now taken a decision. So in this case, I would say before the breakout, and I zoom out here, we can all agree that the relative or the general price movement is clearly sideways. So the market has been moving sideways for all this duration. Even though there are moves in between, up and down, the average price direction is sideways, up until we go to this area, and now we head a clean direction. So whenever you have such kind of a breakout, it's very important to understand how these breakout patterns happen. So first things first, if there's a breakout to the upper side, you know that now you have a buyers. And in that case, you are looking for a buying position. So if this candlestick had happened to the lower side, then we would be looking for selling position. So in this case, after seeing this particular candlestick happen, at the end of the hour or at the top of the hour, remember this is when the candlestick closes, you want to go for a buying position and then set your stop loss on the nearest low. And this is the most recent low. In fact, this was the low of the day. You don't set exactly at that low, you set a few pips below. And in that case, that's your invalidation point. So this means if you go for a buy position here and the market goes back to the same area, then you are taken out and you are out with a loss. And that's the general risk of trading breakouts, where if the breakout was fake and the market goes back, then you take a loss. So on the other hand, what happened here is for the next preceding 2 hours, the market kept going up and then it reversed direction immediately. Went all the way back down to retest the breaking point before bouncing back and accelerating today, and then making a very impressive run. So from this kind of trading setups, if you're trading a setup such as this one, which is a symmetrical triangle, then you might want to look at the base of the pattern. So the base of the pattern is where your trend line starts, either on the lower side or where your trend line starts on the upper side. So the most extreme swing seems to be the nice target for trading such a position. So in this case, after the market pulling back down and showing a nice bounce, and this was towards midnight yesterday, then the idea is to trade in the direction of the original break, which is bullish. So you still go for a bullish position. If you didn't capture it the first time, then after the pullback, then you can also trade it as well. So whenever you see the market breaking this way and making a pullback, it's quite a common scenario. So if you're a breakout trader, you identify such a technical trading pattern, market breaks out. Sometimes it's also wiser to wait for the market to pull back and then you make your entry then. So you don't have to go for a position immediately. Sometimes you may be patient enough to wait for a pullback and then trade in the same direction. So the other key thing to notice is that not all breakouts will have a pullback. Sometimes the market will just break out and keep going. And if you miss out on the position, then you miss out on the position. So this means that you never really get the opportunity to capture that trade. So in this case, the base of our pattern was right here, a high of 1.36365. And clearly, you can see the market playing out and headed all the way up. And there's a good chance we'll be achieving our target at 1.36365, maybe not by the end of the day today, but perhaps in early trading tomorrow. So I normally do these sessions on YouTube. So on FX Pesa channel, if you go to YouTube, you will notice a series called Market Snapshots. So we get to analyze the markets daily at 11 a.m. from Monday to Thursday, and we try to understand the key price levels in the market. So if you are a little bit behind and you want to freshen up on your technical analysis, then you might want to join those sessions and you'll get to benefit from the analysis that you've done. So for a majority of the traders that tend to participate in those sessions, then they were able to identify these opportunities and hopefully they have made some money as the market rallied upwards. So let's look at more patterns that have been happening over the weeks and try to understand how they play out. So Well, on the first example here, we have two trend lines that are facing each other. One of them is bullish and the other one is bearish, basically forming a symmetrical triangle here. We have another pattern that was happening on USD JPY pair, and this now is referred to as a rising wedge. So on a rising wedge, you realize that the two trend lines are facing the same direction. So remove this one just for clarity. So this one is slightly bullish, meaning that it's moving upwards, and this other one is also slightly bullish. However, we cannot call this a channel because the two lines are not parallel. What we are seeing here is two trend lines that are approaching each other, even though they are both bullish. So what you can identify from this pattern is pretty simple. One, the swings seems to be getting smaller and smaller over time. So it's similar to the previous one. But if you compare the highs are getting higher, and also the lows are also getting higher. So in these kinds of patterns, whenever you are trading, you never really know the direction that the market is going to break. So this requires a lot of patience and understanding in these patterns before you get to execute your trades. So if I remove my triangle here, for anyone who is very new to technical trading patterns, you can always find your triangle by going to tools, and then it should be tools, options, if I'm not wrong. No, it's tools, just trying to find the right one. Yeah, you should go to insert and then objects. Then from here, you can identify your triangle. So drawing a triangle is pretty simple. On your cursor, you'll have one, a very small one written on your cursor. Just click once and then move your cursor to another place. But in this time, when you click the second time, make sure to hold onto your cursor and drag it to the third point. So if I click here, hold to my cursor and then drag to the third point, now I have a triangle. So now when it comes to adjusting your triangle, just make sure you double click on your triangle to have these pointed ends. So when you have these dots on each end and one at the center, then you can click and drag your triangle to the point you want. So let's say move this one here, the other one to this low here, and the other point I drag it all the way. And here now I can highlight my triangle. So the way to trade this pattern is also very simple. So you want to trade when the market breaks out. So sometimes the breakout is not so clear. Like in this case, you have a 1 hour candlestick breaking out, and you know that the next candlestick could go right back inside the triangle. So in this case, it's not very safe to go for a position immediately. Sometimes you wait for a confirmation. So the confirmation is the next candle. So you want to see the price action of the next candle to see if it continues that kind of momentum. So in this case, after the confirmation here, now you know that there's a green breakout towards the upper side. And the easiest way is to set your stop loss on the next or the most recent low, and then target previous resistance or support level. So in this case, for the US dollar trading against the Japanese yen, we don't have an immediate resistance. So you might want to look at the previous prices and see or identify a potential target. So we have just broken out of our resistance. You can see the resistance here, the area that the market was unable to break the first time and the second time. So after the market broke that resistance from the forward chart, you can see the market going up, retesting the area and then moving higher. So there is a good chance we could be seeing the market continue to move higher. So one of the ways to identify a trading target in such a case is by connecting the lower side here and also connecting the upper side. So you can see this was more or less like a descending triangle, and then finding the biggest swing in that triangle. So in this case, we know that there was a very nice swing here, the market jumping from this bottom and moving high at this point. And now if we use the same logic to identify a target here, then it seems like the market will be headed to the next possible resistance. So clearly, if the market is going all the way up, then there is an idea to target this resistance here. So you basically play it this way, targeting that the market would continue to rally until it got to the next resistance. So that's one of the ways to identify a target whenever you're trading some of these patterns. So they play the same, whether you're trading on a daily chart, on a 4-hour chart, or even on a 1-hour time frame. So it depends on your patience as well as your targets. So if you're a person who normally enjoys trading a couple of minutes a day, 10, 15 minutes chart would work for you. If you can hold onto your trade for a day, then you could be a day trader. Maybe perhaps use the 1-hour chart so that you can track the price movements every hour. But then if you are a longer term swing trader, then you could consider holding your trades for a couple of days or even a couple of weeks. So the other common technical trading patterns are also available in gold. So for instance, I managed to identify a nice technical trading position in gold after it formed a recent all-time high at this price level right here, which was around 2087. So after forming this high, you can notice how gold has been forming these highs here, and another one here, and another one here. And if I keep extending my trend line here, then you'd notice that there has been a common theme in this market, and it has been following this path right here. So sometimes you don't need both trend lines, the upper and the lower, even one is just enough. So just for arguments purposes, let's say we plot the lows here. We try to connect this low with this low and then this other low. Then I can drag my chart here just to compress it and make sure I have some level of accuracy. And we can say collectively that the price of gold has been oscillating between these two trend lines, moving upwards and then back down and then up, maintaining the upwards trend line before it goes to the lower one, and then back up and then back down. So using these, now we can identify some key price levels. So the trend lines are not just enough to give you the key price levels. Sometimes you use the horizontal price levels to understand the major swings. For instance, we have this high here, and I remember plotting this yesterday. So this high happened to be the highest price on Monday and also on Friday the last week. So Tuesday we traded lower, and then today we traded higher. So also, if you consider the lowest price on Friday, and then compare these with the lowest price that we saw here yesterday, then you can see a key theme happening in these charts here. So one of the key ideas is that this area has been acting as a resistance level. So anytime the price has pressed and attempted to break this level, sellers have come in and added pressure and pushed the prices back down. And on the lower side, we seem to be having a similar kind of thing. So anytime the prices get around this area, so remember, resistance and support levels are not specific prices, but rather zones around which price changes direction. So in this case, we have a fast swing happening on Thursday, then on Friday, a high on Friday, on Monday we test here, price is unable to break, on Tuesday we test here, then on Wednesday we test here. So the idea is to identify these levels so that they can give you an idea of whether there is an outright break of a resistance or a support level or a clean bounce of those levels. So a clean bounce is usually identified by a rejection. So whenever you see, for instance, the price moving up, getting to the resistance level, this was a candlestick that was at first green going up, but then sellers came in and pushed the prices all the way down, and at the end of the hour, the price of gold closed here. So the long tail extending towards the resistance basically indicates a rejection of higher prices and a strong entry by sellers. So this would have been a great idea to immediately use these as your entry rationale. So after this formation of this candlestick, then it makes sense to go for a short selling position, set your stop loss just above that tail, and then your take profit on all the way down, and that's on the support level. So from what we have seen after this formation of this candlestick, there was a 1, 2, 3, 4 straight hours where gold prices were going down towards the support level up until the current candlestick. So if the current hour or the current candlestick were to close at around this area, then you know that we are no longer getting to our target, then perhaps it's time to take profit. However, if you're patient enough and eventually the candlestick closes lower, then in that case, you might be patient to wait for the next candlestick until the price gets to your target level. So this is one of the ways of identifying these trading opportunities. So the other key trading idea in this particular pattern is that we have a long trend line extending all the way from the 3rd of May. So we have been in this pattern for an estimated 21 days. So the market broke outside of this trend line and went all the way to the first resistance. And now we have a pullback here that is representing a retest of this trend line. So remember the key theme I mentioned earlier, that whenever the market breaks a key level resistance or trend line, then it's quite common that the market will retest that area before moving higher. And this was very relevant in USD CAD currency pair. So market breaks the resistance or the trend line, goes back, and then continues in the same direction. So it seems to be a common theme across the markets. So in this case, you have a break, the market goes back to retest the trend line, and now it seems like the market would be headed higher. So if you didn't quite capture the breakout here, then it's always in order to wait for the pullback, retest. And now let's say the current candlestick closes as bullish, then the idea would be, let's say, to go for a bullish position here. We don't just target here, now we target higher, maybe to the base of the pattern. So the base of the pattern seems to be quite distant. So there's a intermittent resistance levels here. So this seems to be a resistance. There's also this area here, which is also intermittent, and also all the way up the all-time high in gold that we saw a couple of weeks ago. So in this case, it might make sense to look for a bullish position if the market closes here. So the current candlestick becomes our sole indicator to see the price action here at the end of the hour, showing us there's a very convincing entry for a price of gold moving higher. So you just have to be patient, and sometimes you'll be wrong, sometimes you'll be right, but whenever you are right, then the reward tends to outweigh the risk you are taking in such a position. So that's one way of visualizing this price action happening in gold as well as in other currencies. So let's look at one more chart and try to understand these key concepts. So now we have a chart of AUD USD here. So remove all my charts here, zoom out, and clearly we can see that there's a common trend that was happening here. The market finding resistance along this area here, and also finding support along this area here. So just to push this closer to the center. So in this case, let's say you identified your first trade swing here as the resistance, and also this swing here as the support. So you haven't entered the trade, you're just analyzing the markets. So the market goes down, forms a support, and starts moving up, and then it gets to this area here and gives you a resistance. So using the 4 points that I've identified in the yellow highlights, you can draw a trend line here and then extrapolate this to the future. Same case here, using the first point and the second point, you can draw a trend line and extrapolate this to the future. So now, when the market gets back to the trend line here, notice how the price happens to move downwards and then gets back to the same trend line. So when the price gets back to the same trend line, you'll be looking for potential bounce or break. So you know the market can either break this area and move higher, or it can bounce from this trend line and move back down lower to the lower trend line. So in such a case, you're trying to observe price action to see signs of bearish entry. So the first candlestick is not convincing enough. Yes, there is equal tails to the upper side, but the body is not completely covering the body of the previous candlestick. So you wait, you see the next candlestick, and the next, and the next. So the first one here is indicative of a slight entry by bears. Second one here is still indicative of a slight entry, long lower tail, still not a signal. But then on the peculiar third candlestick, the third red candlestick, you're able to identify an opportunity where the market was attempting to move up higher, and then it failed. This was an attempted move to break the resistance, and then it failed and the candlestick crossed lower. And now you have 3 consecutive bearish candlesticks and 1 long tail to the upper side, indicating a rejection of higher prices. And this would have been a nice signal to go for a short selling trade, targeting lower prices. Of course, your risk parameters will be within limits. You'd be risking a couple of pips just here. So if you're wrong, you're invalidated after the market moves up, breaks the trend line and gets to the previous high. But then if you're right, then you get to benefit all this advantage. So I understand that this looks pretty simple when you're doing it in hindsight, when something has already happened. But also, if you do it long enough and you keep practicing, then it can be pretty easy to identify even before this kind of sequence has happened. So also notice that when there's a breakout, the same theme applies. So the market breaks out, goes up, and if I use a smaller time frame, in this case, the 15 minutes chart, then you can notice how the price eventually breaks the level very well. So after breaking, there's a retest, market goes back up and gets to the same area, and then forms a rejection of higher prices, indicating that now we are about to proceed much lower. So in this case, after the first set of red candlesticks, then it might make sense to go for a short selling position, trading in the original direction of the breakout, which was bearish. So the same kind of theme keeps playing out in the charts over and over again. And if you understand how to learn these patterns and use them to your advantage, then it's almost like making free money in the markets. But we know there's no free money. So every time you're taking a position, you know you're taking a risk. So you have to do a calculated risk in order to preserve your capital, just in case your trading idea is wrong. So the other key theme, for instance, we have seen a double top pattern happening in US Tech 100. So we had this formation here, and I'll use a higher time frame in this case. So this is the US Tech 100, or what we call the NASDAQ, and it was literally moving from one side to the other side of the trend line, and then down, then up, then down, up until we got to this break last week. So the market broke to the upper side and kept going higher, and this was in contest of a previous resistance level that we had here. So this was a resistance level that was very important in the markets because it had taken a couple of months. It was the highest price in August last year. So when the price got to this level, there was a clean break. The market breaking that resistance level, it's a thick line here, went up and then pulled back downwards. But then what ensued after that is the market rallying again to the same resistance and then moving back downwards in what is clearly looking like a double top pattern. So a double top formation is always in the shape of an M, the letter M. So the market goes up, then pulls back in what we identify as a neckline. So the bottom here is called a neckline, and then the market goes back to the same area, finds resistance, and then goes back down. So after the formation of this pattern, it's a reversal pattern. It's indicating a market that is unable to form higher highs. And now, in this case, you will be looking for a break of the neckline to trade much lower. So what we saw with the NASDAQ is the market breaking instantly and pushing down, basically giving you an idea to go for a short selling position. However, after the break, there was the same theme or concept I'm talking about of the market retesting the area before proceeding much lower. So if you understood this pattern, then today you could have easily executed a trade position after the market retests and forms this series of red candlesticks. So in this case, you go for a short selling position and target even lower prices. So it's quite a common theme in the markets, and whenever it happens and you understand the pattern, then it becomes easy to execute and make something for yourself out of this. So we have also seen similar patterns happening in Brent oil. So this is UK oil on the 1 hour chart, and clearly we can now identify the big swings that have been happening. So from the first swing here, down to this area, and then up, and then down to this area, up, down to this area, and then up, down, and then this resistance here. So the market gets back to support. And I remember earlier this week, this was on Monday, I was telling the traders who are attending the market snapshot series that this is a nice short-term trade where the market has bounced successfully. If you look at the candlesticks here, the first is red, long tail below support, and the next one is a very strong green candlestick extending to the upper side, basically indicating that the market was unable to move down and there's a strong entry by buyers. So in this case, the idea was to go for a buy trade, targets the upper side of the trend line. So target this area here. And also, if you are wrong, the invalidation point is just here. So you're not taking much of a big risk, but in case you're right, you get to benefit. So this took a couple of hours to get higher, and then the following day eventually got to the target. So notice what happens after the market go to the target. So the price kept going up. So eventually breaking this area here. Then it went back to the same trend line as a retest. So we can see the sequence of number of times the market has retested, and then it rallied all the way up. So the other key concept you have to understand is that the market doesn't have to retest a level once. Sometimes it may retest a level a second time, or even a third time before proceeding in the direction of the break. So what I'm seeing here, or what I'm observing in the price of Brent oil, is the market moving back to the same trend line as another retest of what was the breakout here. And now, once the market gets back to the trend line, then the idea is to look for bullish entry. So if I see buyers entering this market, which would be presented by the closure of this 1 hour candlesticks, then I might consider trading the bigger pattern, which would be the market rallying all the way up to the next resistance. So the base of the pattern is all the way up. So we are looking at a key price level of about $80 per barrel. So we have already hit our first resistance. So now an idea of trading towards this area becomes viable. However, this is not guaranteed. You play this based on what price presents to you as a trader. So it's very important you learn to identify these patterns, especially the triangles, because they can give you an immense amount of opportunity when you are trading. So generally, you identify that for this period, the market was just moving sideways. So there's indecision in the market. Nobody knows whether the market will go up or down. So it's basically a fight between bulls and bears in these charts. However, if you see the market moving towards the upper side and making a break, then you know that the bulls are winning. So in this case, you want to place your bets with the bulls and increase pressure to keep pushing higher. So let's look at one more chart here. So now we have another chart here, basically showing a channel. So the channel was playing out really well with pound USD. So for the last couple of days, the pound USD has been swinging between these two trend lines. And now you can see what happened today. So this set of parameters can play out sometimes in your trading, where the market is playing within a trend line. And then you happen to see a breakout. And then let's say you go for a position immediately. So early in the morning, there was some news in the UK, and this was regarding the inflation data, which came in lower than 10% for the first time since August. But then also core CPI for the UK basically came in higher at 6.8%, and this was the highest core CPI since 1992 in March. So a lot of investors got caught in this bull trap by buying here and targeting higher prices, but immediately on the following candlestick, the price went back downwards. So the red candlestick would have been a very nice indicator that now price is headed back down towards the lower trend line. And as a trader, you should have used this strong reddish candlestick as your entry for a short selling trade targeting lower prices. So while on the other hand, you could have been caught buying and the price reverses. Then once the price reverses, then you change your mindset and identify a trading opportunity towards the lower side. So this kind of setups tend to be prevalent over and over again. So Now we have another chart here, which is the New Zealand USD, which if I zoom out, you notice there has been a very nice price action pattern happening on the daily. So price finding resistance consistently on this trend line. So knowing this, if you are trading at the previous high here, when the market was approaching this area, then the idea was to look for price action rejection. So notice what happens here. This is on the daily. So you are looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 consecutive days, the New Zealand dollar is just making or creating ground against the dollar. And then immediately after you get to the trend line, which is the resistance area here, so you have two long upper tails and a very strong bearish momentum candlestick, indicating a very strong entry by sellers on that day. So in this case, you literally go for your position, a short selling position. So your stop loss, of course, goes there, and your take profit, in this case, goes towards the lower trend line. So sometimes it can take some time. Notice how it took a couple of days, the market trying to go back up and then eventually dropping. And after a couple of days, you're able to catch up with your target. So now what we are seeing is the market accelerating downwards. And now we have a potential for a break. So going forward, if you had a short position, you are taking your profit here. But then towards the end of the day, you'll be trying to understand if there's a clean break of the lower trend line, so we can keep trading lower. But then if the market pulls back and closes at the trend line, then we might have to wait for another day to see the price action around here. So there are only two options here. The market could literally bounce tomorrow and we see a reversal, or it keeps going down and then we have an idea to keep trading downwards, betting on a strong dollar against the New Zealand dollar. So that's one of the ways that you keep identifying these patterns. So I know I've done a lot of examples with higher time frames. So perhaps it's a time we look at a lower time frame. So yes, we also had these rising wedge formation happening in Euro USD, lows getting higher and highs getting higher. But eventually the market happened to form a breakout here. So the retest happened here and the market went all the way down and has been going down since. So it's a very common theme, especially for these rising wedges, can break out to the upper side or to the lower side, but the retests tend to be common. So the longer term target for my Euro USD position was to go for the base of the pattern, which was here. So clearly, after the market got to this area, this was supposed to be the exit. And now we wait for the next kind of setup to happen in the Euro USD currency pair. So let's say I look at another chart, and in this case, I'm trying to identify something in the shorter time frames. Let's use the USD trading against the Chinese yuan. So in this case, I'm looking at a 15-minute chart. So notice how yesterday, the price was consistently unable to break this price level. And on the lower side, it was also consistently unable to break this price level. So in the morning, price opens here. There's little or no volatility, goes up, down, and then spikes all the way up. But then after it gets on this movement here, you start seeing these long tails to the lower side, indicating that the price is unable to form higher lows. So eventually it breaks to the upper side. You start seeing some resistance here. Then it goes back to the lower side, gives you some support here. To the upper side, gives you some resistance here. And using this point, you're able to plot your trend line. So eventually, the price moves for one final time to the lower side. And then you have a clean break happening on this green candlestick. So after this happens on the green candlestick, you basically identify the trading opportunity, go for your bullish position, your stop loss just below the pattern, right here, just below this tail here. And of course, we know that the base of the pattern is not very far off. So the base of the pattern is just the most recent high here. So you don't target some aggressive price action. Just go for this target, and in the next 15 minutes, you're able to capture that profit and get off the markets. So some of these patterns can take very short-term targets. So remember, I also mentioned this as a measure of your target. So if I measure from the low to the high of the biggest swing, I can transfer this here and identify the target for my trade here. So if you're an advanced technical price action trader, then you know that this is the right target. But if you want to be sure, then you just use the previous high, and this would have also been viable. So the market eventually went all the way up, got to this area, people took their profit and the market reversed. So you will tend to see these price action patterns repeating over and over again. And once you learn to practice identifying these winning possibilities, then you'll have a much more improved performance in your trading. So that being said, I would like to check out and see if you guys have any questions arising from the presentation before we get to the end of the session. So you can feel free to type your question in the comment section, and I'll be responding to that right away. So comments are also welcome. All right, everyone. So if there's no question or comment, okay, I have seen one. So let's see. Kindly clarify on identifying a reversal using candlestick. Is a Chinese currency also in major currencies? Yes, it's not in the major currencies. It's a chart that I used to identify a technical price pattern as an example. So when we talk of major currencies, we are basically talking about the top 7 stable economies. So we normally use the Canadian dollar, the euro, the Swiss franc, the pound, the Australian dollar, New Zealand dollar, and the Japanese yen, all traded against the US dollar. So yes, there's that distinction. Which is the most appropriate time frame to trade with an account of $100? You should probably do something short term, because an account with $100 would not be able to sustain a big drawdown. So anything between 15 minutes, 1 hour, and 4 hours would work well for you. Just don't do like big crazy time frames like 1 day. So using identifying a reversal using candlesticks. So you just have to understand the candlesticks first and how they are formed. So when you are looking at candlesticks, we know how they are formed. Each and every candlestick represents a price action summary for 4 prices. So for instance, if I'm on the daily chart here, and I look at one candlestick for any particular time, let's say I use this day here as an example, then I know this was the opening price for the day, this was the closing price, and the extreme prices are indicated by the wicks or the shadows. So this was the highest price of that day and the lowest price of that day. So I have covered this sufficiently well on the Novice to Pro series. So what you want to understand is the size, the relative size of the candles, and also the relative size of the tails. So for instance, if I'm looking at this candlestick here, let me just explain here. So if I'm looking at this candlestick here, I know price opened here, closed here at the end of the day. This was the highest price and this was the lowest price. So this basically implies that somewhere within that day, there was a time that the price had gone all the way down to this point, and then it went back up to this point, meaning that lower prices were rejected during that period. So we use that to interpret the rejection of lower prices. This could be a signal for a rejection. And also the bodies are also important. You can see another example here where on one day, price was going down. The following day, price moves upwards by a bigger momentum. indicating that there is a very strong entry by buyers. So I know I can't explain this in 1 or 2 minutes. I've done an entire hour explaining these candlesticks and how they work. So if you don't mind, I would like to kindly request you to check out the candlestick webinar available on YouTube on how these candlesticks work. It's on the Novice to Pro series. So last question here is a comment on the US debt ceiling talks. So it's the most important topic of the day here in the markets. So we know that there's the US President Biden trying to basically negotiate with Congress. That is the representative for Congress is Kevin McCarthy. So on one hand, the Democrats are trying to expand the US debt ceiling, which currently stands at $31.8 trillion. So the current law in the US only allows the US to borrow up to $31.4 trillion. So far, the US has already exceeded the debt limit. And now they want to expand this so that they can borrow more and the government will be able to sustain and honor its obligations. So the US government is largely running a deficit budget, meaning that it's spending more than it's collecting in terms of taxes. So the way it does this is by creating more debt, and the debt ceiling keeps getting higher and higher. So through this self-imposed law, the government is facing a potential default, which is expected to be happening on as soon as the 1st of June or somewhere close by after 1st of June. So Congress, on the other hand, which is basically dominated by the Republicans, they want to foster what we call responsible spending with the Biden administration. So they are not completely against expanding the debt ceiling because they know that if the US was to default on its debts, then it would be catastrophic for both bond markets as well as equity markets. And they don't want that to happen. However, they have their own set of laws or bills that they want implemented so that if these guys get one share of the bread, they also get the other share. So what they want is to cut the US government spending. So they want to set spending limits to make sure that this problem doesn't keep occurring again and again. Because if they just agree with a bank statement that they agree to push the debt limit higher, then the government appetite for spending will continue being big. And a couple of weeks down the line, we'll need to have another sitting and they'll be looking to expand the debt ceiling again. So they want to control the spending of the government and make sure that the government doesn't spend the way it has been doing. So far, the negotiations have really dragged along. So there was a meeting yesterday in the evening. Today, we also have another meeting between House Speaker McCarthy and President Biden. So they're all trying to get to a deal somehow. So in the past, this has happened before, and every time they've met and had these political discussions and negotiations, in the last minute, usually they get to sign a deal. So the idea is, if they eventually sign a deal, the government is still broke. So the government will have to find to raise funds somehow. So this may imply selling more bonds in the markets in order to raise capital, and then the government would use that money to honor its obligations. Or we could be seeing the US defaulting on some of its obligations. So the US government has just too many obligations across the markets. There's bonds, there's people's salaries, there's contractors, and all kind of counterparties. So if this happens, it may start with a small movement, a small delay of several payments before they actually sign the bill. And this fear and panic may have something to do with what we are seeing as the volatility in US equity indices. So US, since yesterday, we have seen the NASDAQ drop very well. Today has kept going down. If you look at the Dow Jones, it has also been moving downwards, and also the US 500. So one of the reasons we are seeing these is investors being concerned about the US eventually being unable to honor its debts. So more developments will be happening over the week. So keep a close eye on those developments to understand what may happen going forward. And that might give you a premium trading opportunity in the markets. So thank you very much, everyone. And also thank you guys for your participation, for taking time to listen in, and also for the questions you have raised. I really appreciate this. I hope you've had a good session, and we will keep the conversation going in the group. So I hope to see you on the next session.